Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like the Silver Shield and Heroes SD War Collection, to our exclusive line of insurance-approved, TL-rated precious metal safes, SD Bullion has what you're looking for at the lowest prices, period. Guaranteed. Find out why over 15,000 new customers have recently made the switch to buying their gold and silver from the dock. Give our team an opportunity to earn your business today at SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, it's finally been a nice big week for the metals. Silver up nearly 10% over the last week and a half here. Traded midweek actually above the 16 handle and closing the week here just under 16. But really gold's been the story here today on Friday, really over the last 2 days, Thursday and Friday, powering higher throughout the day today to make a weekly close, not even a daily, a weekly close above the 1150 level. So what's your take on the significance of that, Eric?
Well, we're definitely turning the corner. We always go through this process where when we have higher lows and are fighting back from cartel attacks, and in this case it was the most aggressive back in July. And it was only back, like the show before you and Dave Pranzler were speaking, that we were looking at the markets and saying that it would probably stabilize and begin to move higher. But the cartel and the copycat sellers that dogpile in response to watching this Pavlovian behavior having been established by the cartel in the suppression of gold and silver are so potent and powerful in the paper markets that you never really can tell when, in fact, you're going to see the real fundamentals assert themselves to the point where you actually begin to see a trend change. But I think that we are now in that process, and it matches up really nicely seasonally from the typical lows that we see in the precious metal space in July. It happens quite often because it's tied to holiday buying patterns and the festivals in India and gift-giving season in the New Year in China, and all of the wholesale and retail and jewelry supply chains associated with that, gearing up for what is now, as we stand latter portion of September, moving through the rest of the year in the seasonally strong period for precious metals. And that's where we are, that's what we're seeing. But when you add on top of that the return of the fear of systemic risk and default and creditworthiness of sovereign bonds and the credit default swap overhang and the derivatives market has been accentuated by this issue with Glencore and Deutsche Bank. It's spotlights for the conventional Wall Street thinkers that we speak about a lot of times, the risks that they, for the most part, have been free to ignore for many months because of the thesis that central banks have their backs. And in fact, they did have their backs last month because we saw this gigantic amount of reverse repo operations going on that Dave Pranzler had spotlighted in an article about a week ago. Fantastic article, pretty similar to the kind of thing that he put out, I think it was back in January, but it certainly was the first quarter of this year when we were talking about it in the Bird Dog, that there was a lot of similar activity in the fourth quarter of 2014. And in fact, actually throughout the whole year, we saw a lot of reverse repos. But in any event, we saw that combined with that gigantic shift in Citigroup's derivative position in the precious metal space last year. These are the kind of things that sneak out from a data point of view that show that regardless of what they speak about on CNBC and Bloomberg and mainstream financial press, etc., the reality is that there are huge operations going on behind the scenes to put out gigantic fires, and that is the entire thesis that is in Dave's article. We'll put a link to that in the show write-up for this show. Looking at the graph of the reverse repo action is mind-boggling. I mean, when you compare it historically to what's been going on with the Fed, starting in 2014, we've seen this gigantic reverse repo operation that inserts high-quality Treasury collateral because the Fed, in a reverse repo, buys from the open market Treasuries, and in turn, the seller of the Treasuries sorry, I got that is backwards. I'm talking repo. They're buying, they're injecting treasury collateral into the system, and that is the primary collateral that backs up traders' positions in derivatives. So when we go through a period like last month when there was a lot of crazy action in the markets, last 2 months even, and a lot of pressure coming on to companies like Deutsche Bank and the whole banking system, it's clear that there was a three-alarm fire going on with the Federal Reserve primarily, but the ECB and probably the Bank of Japan as well participating in these kind of things in terms of market salvage operations. All of this points to the fact that the markets are a heck of a lot less healthy than what the mainstream media propaganda meme is, and more and more people are beginning to recognize it. I mean, when we peaked back in, I think it was January 22nd, if memory serves, somewhere 22nd or 26th, somewhere around there, of this year in silver and gold, part of what was going on at that point in time was the paper traders beginning to fear the systemic backdrop of the euro and the eurozone given the turmoil in Greece. And we're beginning to see the same kind of fear of systemic problems. And then when you add on top of that the bigger perception that it's not likely the Fed is going to raise interest rates until 2016, all of a sudden we have a lot more paper traders flooding in the North American market for gold and silver, and that's part of the reason why we've been moving up. I mean, they can see as well, too, the huge premiums. We were like a third of the price at a spot basis for American Eagles, and the wholesale chain backed up. And
that was at a monster box. If you're buying a few coins or two,
yeah.
It actually broke 50% in some of the larger online retailers.
Yeah, and some products just going no bid. I mean, you can't find them, no offer rather. So it's getting to the stage where even the big boys that make lots of money shorting the heck out of zinc and base metals in general and silver and gold as they copycat the central bank pressure from cartel points of view, as well as just deflationary downward spiral and China slowing down economically, creating less demand for base metals. And even in the conventional finance world, there's been this thesis. Even Jim Rogers, of all people, were saying 6 months ago that you travel around China and see that the retail store chains for jewelry were not seeing a lot of customer action. It's just this general perception, distorted as it is, particularly in precious metals, that there's been demand issues going on. So all of that kind of stuff is beginning to change, and it's interesting to see. Even today, Glencore came out before the London Open, and we're recording this on Friday, end of the market close on Friday. And their stock went up quite a bit because they said they're going to cut zinc production by about a third. And the CEO earlier in the week was out on the airwaves saying things that we could only wish that precious metal CEOs would say. Pull up the quote here so I can quote it. This was on a Bloomberg interview, and he said, "It's clear that there's distortions. How big they are, we do not know, but eventually the fundamentals will prevail. The funds are playing various commodities on a derivative side. Eventually the physical will drive the actual commodity price." I mean, how novel is that? And the point is that here we've seen this pretty big shift in base metals today, and I've looked at Glencore in a much bigger perspective than just, what they have been trying to do to put out these fires in this last week. And I know that when we spoke to Sean at SGT Report last week, he probably was a little surprised when I said that Glencore, in my opinion, was not going to be a systemic threat issue. Unlike Deutsche Bank. I mean, Deutsche Bank's like a time bomb that's just going to go off at some point. I don't think that's a salvageable kind of scenario because of the systemic burden-esque risk that they have. It's similar to Morgan Stanley. It's similar to JP Morgan to some extent. I mean, these banks are just so over-levered when it comes to their derivatives exposure that the systemic risk exists, and it's only a bubble or waiting for a pin. And at some point, those kind of things will probably break down the system. And that's not a story that's anything new to all of our listeners. I don't think I need to really dive into that just yet. I mean, some of our new listeners might hear something like that and think, well, what's the basis for that thesis? But we only have so much time to discuss today. But the bottom line is that when we see Glencore go up as much as it did today, and the reaction, even in the silver market, because a huge percentage of silver, like 80+% of silver production on an annual basis, comes out of the associated production that comes from zinc mines and gold mines and lead and et cetera. And Glencore is strong enough from an asset point of view to be able to withdraw funds to the market. I mean, if you look at the shale market now and how much pressure has come to oil producers, both large and small in the United States, a lot of them have just jumped on a treadmill and decided to produce as much as they can simply by the desire to obtain cash flow, regardless of whether or not it's profitable or not, because they have to pay off their loan contingencies. And here, Glencore is taking a more aggressive stance. I mean, they're literally going to just thumb their nose at the speculators and downturn that's also economic, and in turn hope to push copper and zinc and so forth up higher by reducing the amount that they bring to market because they're such a big player. So, I think that to some extent the precious metals community, the pundits, the analysts, etc., are overestimating the degree to which Glencore represents a systemic risk. I mean, it's a major problem. I'm not poo-pooing it. I just think that it's not going to be a catalyst that's going to bring down the entire market. And that is really the take-home differentiation between a scenario like Glencore and what's going on with Deutsche Bank. And I think that Deutsche Bank is probably more integral to the story that Dave Kranzler was outlining in the last couple of articles that he talked about with those reverse repos. But we'll put a link to the reverse repo article in the write-up for the show. It speaks for itself. It shows that there has been a crisis under the surface, and the financial media and the mainstream is completely ignoring it.
Let's switch gears a little bit here back to gold and silver and give the listeners a quick update on physical markets here in the U.S. As we reported on Silver Doctors earlier in the week, the U.S. Mint increased production or allocations on Silver Eagles this week for the second straight week. They offered up 1,075,000 coins this week. I think it was up about 5,000 or about 75,000 coins from an even million last week. But just a couple weeks ago, they were only selling 750,000 coins. So it's I think about a 40 to 50% increase from just a couple of weeks back. And that combined with silver's big run of about 9 or 10% over the last week and a half has seen the market ease up slightly. And what's interesting is I was discussing with Eric here before the show began, and we touched on this a little bit in last week's show, but it's become much more pronounced this week, is that a shortage remains on the wholesale market. It's actually more severe in the wholesale market right now than it is on the retail market. And for several different products, Silver Eagles in particular, the wholesale market is actually about $1 over spot higher than the retail market. Like, for example, SD Bullion is offering monster boxes of Silver Eagles for $3, I think it's $3.97 or something. It's under $4 over spot, but all of the authorized purchasers from the Mint are around $5. A couple of the little guys are, I think, offering about $4.25, about 4 to 6 weeks out on delivery. And really what the reason for that and the implication is that all of the big boy online retailers, when we had that big demand surge and silver crash a few weeks back where silver plunged down to about $14 an ounce, they basically bought future orders as much as they could, and now 4 or 6 weeks later the retail dealers are finally taking delivery of those coins. And this week we have seen a tapering off of retail demand. It has not been what we were seeing the past couple of weeks. So the result of that, market forces have eased premiums a little bit, which is really a nice thing to see for the retail investor. As Eric was discussing, we were seeing Silver Eagle premiums up near 30 to 50% just about a week and a half ago. So, and another sign of that, 90% silver is actually available on the market right now. Now the premium is pretty high. It's about it's offered right now between $5 to $6 over spot per ounce, which is extraordinarily high for 90%, especially for investors who are used to purchasing it somewhere around like $1 or $2 over spot, higher. But I mean, ever since I think early July, there hasn't been any to find anywhere at any price. It's been no offer. So that is another sign that there is at least a few coins available on the retail market finally.
Has 90% come back at all?
The premiums have. The premiums are between $5 to $6 over spot or higher on the retail side and pretty much on the wholesale side. But there actually is a little bit of volume in the wholesale market that there is some 90% available, likely from some investors lightening their hands and selling some coins with silver's move up here of about a couple of dollars.
And the buyback prices as well have been $2, $3 over spot pretty consistently for the last 2 months or so in 90%. So even though when people were licking their wounds when we were at $14 silver, they still were able to sell the 90% at a much higher buyback price.
Yeah, and I think it'd be interesting to explain to the listeners a little bit, as even in a couple of other metal sites this week, I noticed a lot of comments of people just somewhat skeptical that suddenly there's some silver available now that silver has jumped up a couple of dollars, and there seems to be this perception that all the dealers have just been holding back all their coins, not willing to part with it at $14 an ounce silver. And I mean, just from a business perspective, that it's not possible, it doesn't make sense, and really the rationale and the reasoning is just that the delays we've had, the big online sellers are finally taking delivery of orders placed in July or early August. So here we are in October, so finally some coins are available. And then couple that with a bit of a decrease in the frenzy pace of demand we've seen over the past month and a half, with silver jumping up 10%, and market forces ease those premiums back a little bit.
Yeah, about 2 months ago when we were in the depths of hell, there was one relatively prominent analyst in the precious metal space who was making the argument that dealers were, as we were sliding down the razor blade pricing from 17 or whatever, mid-May, moving down to 14 in July, August, that dealers were just simply holding onto their inventory because they didn't want to sell it because they bought it at a higher price. And that was the argument that this person was putting out. And I don't know the exact percentage of the industry in terms of the retailers that hedge and the wholesalers that supply the retailers, but I'd imagine that it's pretty darn significant.
Anybody who's not sitting at a local corner shop in Hicksville,
exactly.
Ohio, does not care. Their bottom line is not affected, for the most part, whether silver goes up or down. And as we've discussed in previous shows, we're probably the lone exception to that in the fact that SD Bullion chooses to, rather than hedge per dollar, fiat dollars, we hedge per ounces. But we're still hedged for the number of ounces. So really, in my mind, it doesn't matter whether the spot price goes up or down because the number of ounces remains the same, and I'm a long-term fundamental believer in gold and silver. And really, we're if you listen to our show when we discussed that philosophy a couple of months back, the major metals wholesalers, they think we're crazy, and they can't wrap their head around why we would even want to conceivably have that philosophy. It's just the fiat dollar hedging is so ingrained in the whole industry.
But would you think that it's probably accurate to estimate that in terms of both volume on a coin basis or ounce basis, as well as dollar value, that in North America we're talking easily 80% of the volume for physical metal is hedged? I mean, the large APMEXs of the world and whatnot carry
I would say
hedge
98 to 99.5% probably.
Wow. Okay. I mean, I knew it was really high, but never been able to find any statistic that can narrow it down. But that basically makes the argument that this person was making completely moot.
Yeah, exactly. It's completely moot, and it's really just not understanding how the big players operate. It really doesn't matter at all the spot price that an APMEX acquires the product for. Now, what you can't hedge for, and what does add some added complexity to the market and can increase premiums a little bit just due to the uncertainty, is the massive fluctuation in premiums, because that can't be hedged for, that can't be predicted. Nobody can accurately predict what a Silver Eagle premium is going to be on the wholesale market next week or in 2 months or in 3 months. I mean, 2 to 3 weeks ago, most of the market thought imminently premiums were going to $6 to $7 an ounce on Silver Eagles, and they would have if spot prices would have turned the other way and broken through $14 an ounce. We'd be talking about $7 or $8 premiums on Silver Eagles right now, because there wouldn't be any coins. So that's the one part that nobody can hedge. Nobody does hedge. You can't hedge premium.
Pretty interesting stuff. Well, it's been a great week, and it's nice to see the metals turning around and following seasonal patterns as expected. I mean, it's nice to see metals doing things that you would expect to be economic, and they're following of economic patterns and responding to shortages in the marketplace. So on a going forward basis, I think this is that we have in fact turned. I mean, there's no, like we were talking about before, there's really no way of knowing if the cartel or copycat speculators helping the cartel can in fact get prices down at some future month or what have you in the balance of this year. But I think overall 2015 is probably going to see prices continue to move higher. I mean, it's interesting just looking at the chart of both silver and gold, and we were talking about the paper traders, and the paper traders love technical analysis. And earlier this week, silver popped over the 200-day moving average, and that's exactly when the cartel came in and beat snot out of it on Thursday. They don't want to send any signals to these paper traders, but as we move over the next 2 months or so, just the natural tendency of the market, even if it were to go sideways for the most part, would have the 200-day moving average exceeded by the spot price, and that's probably the same for gold as well too, because gold isn't too far away from the 200-day moving average as well. So that's just one other thing that's going to come into the picture. So you have the duration of this bear cycle that we've been in. You have the seasonality factors. You have the distortion of the lies about demand in China, the explosion in India, and the goofiness of their crazy schemes where they're going to try to have bank paper deposit gold accounts for people and offer people interest, and on and on. I mean, the North American buyer reawakening over this summer with the crashed prices. I mean, the list of fundamental factors that support higher prices, if we were to enumerate each factor, could easily exceed 50 different items. I mean, the fundamentals for higher prices in precious metals is a thesis, I think, that is stronger now than what it was in the year 2000, at the beginning of the bull market, given the enormity of financialization that has taken place with the quote-unquote paper printing, electronic keystroke generation of credit, fiat credit, going berserk. The strains in the system that we can see, as an example being that great research that Kranzler put out. I mean, all of these things all together point towards the inability of the cartel to keep this game going on forever. And last week we had Steve St. Angelo on talking about what's going on in carnage-wise in terms of forward supply. I mean, this Glencore example is telling, and it really would be nice if CEOs in the precious metals industry were to take a page from what Glencore just did, but probably not. Unfortunately, I think that the precious metals CEO backbench is pretty weak. We haven't seen the best of management teams in precious metals industry, and Wall Street has that opinion as well too. And it isn't just it isn't unique to the industry, but because of the pricing manipulation that's been going on and all the craziness, it certainly has accentuated bad decision making as well in the precious metals industry. I mean, for the most part, I would say maybe only about 20% of the management teams in the industry really are super cognizant of this manipulation and the degree to which their markets are being managed. And it's kind of hard to have advocacy organizations and the industry CEOs standing up for their product when they don't even understand what's going on. But it should be a good year, and 2016 should be an exceptional year for precious metals. I think that we're going to see a rebirth of the bull market, and a big part of that story is going to be paper traders no longer believing that central bankers have their back and that the financial system is going to roll over, and that stocks and bonds are going to be pressured and we'll have higher interest rates, and all of these things are beneficial for precious metals. And I should also put in as a footnote, it counter to what most people understand. Rising interest rates are in fact very frequently, given what goes on in the economic backdrop, positive for precious metals. What really matters is whether or not you have negative real interest rates and offering no competition to gold, and that is in fact where we are now, given the real rates of inflation that are not really accurately reported by governments.
All right, and we'll close this week with a stat that's almost hard to believe with all the beatings we've endured over the past 6 months, is that silver is now up for the year in 2015. It doesn't seem possible, does it, Eric?
You sure?
I did a triple take when I read that today.
Yeah, it just goes to show how painful this whole 4+ year bear market has been.
We'll just call 2011 to 2015 terrible, but definitely some signs of encouragement here with gold closing the week above that 1150 level in my mind, and wouldn't surprise me really as soon as Monday to see it try to challenge the moving day average. I think it's around 1180. Is that right, Eric? Off the top of your head? I believe last time I looked it was around 1180. If we can clear 1180,
yeah, then
we'll see some upside momentum, and silver will definitely play some catch up with gold if gold were to take out that 1180 level. But
yeah, and 16 for silver is pretty critical too, and then 1850 thereafter. And if we're able to get through 1850 this year, we'll be lining up for the next major sticky point on the chart that'll serve as resistance, and that'll be about $22.
All right, so we'll keep our eyes on the metals early next week to see if we can continue this strong rally we've had over the last week and a half. So for the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.